Hello and welcome to another tutorial video. This time around, we're going to be going over the concept of capital leases and enterprise value and the proper treatment of them there and in valuation multiples. So the reason this question came up is because the other day we got this angry sounding comment / question saying your treatment of capital leases and enterprise value is wrong, referencing one of the previous lessons or tutorials on enterprise value. You should not add capital leases or any leases when moving from equity value to enterprise value because they're all operational items, not debt. So as usual, I'm going to give you a short answer to this question / complaint, and then we're going to look at the longer explanation and go into it in a bit of detail in Excel. So the short answer is that you could make this argument, and there is definitely some disagreement over the nature of leases. Some people believe that they really are operational decisions and therefore operationally related, and that the way a company finances its office space or equipment or machinery shouldn't have any impact on its enterprise value. Other people make the argument that not only are capital leases a financial item, but operating leases should also be viewed as a financial item because they should also be viewed as a funding source or as a separate investor group in the company. So there is definitely some disagreement. However, from a practical perspective, you pretty much have to add capital leases when calculating enterprise value so that you get consistent valuation multiples that don't require adjustment. The problem is that if you don't add capital leases when you move from equity value to enterprise value, you have to adjust the denominators of valuation multiples like enterprise value to EBITDA. So you have to go in and adjust EBITDA. You have to go in and adjust EBIT if you're using enterprise value to EBIT, for example. In theory, this approach might work, but the problem is that most companies don't disclose enough information to make these required adjustments. So let's step back for a second and just go over the difference between operating and capital leases first, and then we'll explain some of the issues that come up when you attempt to use different treatment for capital leases. With an operating lease, the company signs an agreement to pay a set amount of rent each year, and there's no ownership of the asset. So on the income statement, all that happens is there is a simple expense called rent or annual rental expense within the company's operating expenses. Here's an example of what it looks like in Excel. We have the company's income statement, and then down here, we have operating expenses, we have SG&A, we have the annual rental expense, and then we do have depreciation and amortization as well, but they're not related to the company's assets that they're leasing. There's actually nothing there. If you go and look under interest income and interest expense, they do have interest expense on the normal debt, but none of the interest expense is related to the leases that the company has. And then if you look at the enterprise value calculation here, equity value to enterprise value, we don't have anything for the leases because the company has only operating leases at this point. Now with capital leases, the company records the leased asset as PP&E on its balance sheet, and the lease itself is counted as debt on the liabilities and equity side of the balance sheet. As a result, on the income statement, there will be no rental expense, but the company does record depreciation on the asset and also interest expense on the debt. So in Excel, it would look something like this. Notice how we now have nothing for the annual rental expense, but we do have something for the depreciation of these capital leased assets, and then we also have interest expense on the capital leases themselves. So capital leases really are more like a combination of debt or using debt to purchase an asset, depreciating that asset, and then recording interest expense on the debt that you've raised to do it. In the enterprise value calculation, we add capital leases. So here, enterprise value has increased as a result of these capital leases. The problem comes up when you start dealing with valuation multiples. And the problem here is that if you include a balance sheet item in the numerator of a multiple, you have to exclude the corresponding expense in the denominator. And by exclude, we mean add it back. The opposite applies if you exclude an item in the denominator. If you don't have something there, then you need to include the corresponding expense in the denominator. So the classic example is debt. We include debt in enterprise value. So in the enterprise value to EBIT and enterprise value to EBITDA multiples, we exclude the entire interest expense that corresponds to that debt. So we include something in the numerator and then we exclude the corresponding expense line item in the denominator. And if we were to go through that exercise here, for example, let's take our EBITDA So we'll take our EBIT and then we'll add depreciation, all forms of depreciation and amortization. We don't have to do anything with interest because our operating income here is before the interest expense has even been recorded. So we can just take our operating income and add all forms of depreciation and amortization. And we can get to that. Our enterprise value here is just going to be the same because in future periods, it doesn't change when we calculate valuation multiples. And since we are completely consistent, since we have added our capital leases to get to our enterprise value, and since EBITDA excludes the depreciation of the capital leased assets and also excludes all the interest expense here, we can simply go in and for the enterprise value to EBITDA multiples, we can take our enterprise value and then we can just divide by EBIT. And so we have that. So that's how it normally works. You can think about now the problems that this rule creates for the treatment of capital leases. If you do what we just did and you add the capital leases, it's easy to calculate enterprise value to EBITDA because EBITDA already excludes all the depreciation and interest. By definition, since it excludes all depreciation and interest, in other words, it adds them back or it never had them to begin with, then the depreciation and interest from capital leases are also excluded from EBITDA, and so this rule is satisfied. On the other hand, if you do not add capital leases when you move from equity value to enterprise value, you run into a problem. Because now, since you do not have them in the numerator, you have to include the corresponding expenses from them in the denominator. So you have to actually include the depreciation and interest from capital leases. In other words, you have to subtract these out, and then you get a very different metric. So the adjustment would be to take EBITDA and then to subtract interest on capital leases and then the depreciation on capital leased assets. If we do this and illustrate it in Excel, it would be something like EBITDA minus our depreciation of capital leased assets minus the interest expense. We can use a plus sign because it already has a minus there. And then instead of using the normal enterprise value metric, we'd have to take our enterprise value right here, and then we'd have to actually subtract the capital leases out. And so you can see now the multiples change slightly. So that is what we would have to do if we did not include capital leases. We did not add capital leases when moving from equity value to enterprise value. The first problem is that there is some confusion about what exactly you call this metric. It's not really EBITDA anymore because now you are including some interest and some depreciation. Do you call it EBITDA adjusted for capital leases? Do you call it pro forma EBITDA? Do you call it EBITDA minus interest and depreciation on capital leases? The other problem is that the company may or may not disclose enough information to actually make this calculation. For example, a lot of companies will not break out interest and depreciation from different sources separately. They'll just list a lump sum number. Also, even if they do disclose information on some of the leases, they might include all the expenses associated with those leases together. So they'll list interest, depreciation, and even principal repayments on capital leases all together. One example is if you look at Southwest Airlines filings, the way they disclose it, they have capital leases and operating leases. They also have subleases. But under capital leases, they're not breaking out different expenses separately. They're just showing everything together all in this one column. They're not even breaking out interest versus depreciation separately. They're not breaking out principal repayments, if there are any, on the capital leases. So that's another problem that you run into here. So the bottom line with this is that we recommend keeping it simple. Add capital leases when moving from equity value to enterprise value. It's not because of philosophical arguments or because we think all leases are financial in nature. There is debate around that, and you could easily make the argument that they are actually more operational. But in terms of practicality, this is the best treatment. It's best to use standard metrics like EBITDA that everyone is familiar with and that can be easily defined and calculated. You should avoid new non-standard metrics or numbers that require additional footnotes or explanation. The classic example being companies like Groupon that tried to go public with very strange metrics like consolidated segment operating income that no one knew anything about and that the company had to define. They later had to go back and change their plans and remove those types of metrics because they face so many objections from using them. So that's what we'd say about capital leases and enterprise value. You should now have a better understanding of why we always recommend adding them and how it simplifies your life when calculating valuation multiples and valuing companies.